Francisco, this is Tony Crescenzi at PIMCO. When we think about commodities generally, we know that speculative fervor can play a big role in the way they behave. And so what I like to do is look at the non-tradable commodities, such as vanadium, which goes into the making of steel, or steel scrap. These things tell us more about the real economy. And so to what extent are you detecting some change in speculative fervor? Because that can play, as I said, a big role in pricing. And these days, speculation on commodities is growing not only because of unrest in the Middle East, but because people seem to view it as an asset class that has good return possibilities in the years to come.
Right. Well, look, I mean, have you included rare earths into your calculation? Because if you have, maybe you get different results. I mean, I think it's you know, each commodity market at the end of the day on the spot market is driven by supply and demand fundamentals. Of course, speculators can come in and accumulate the physical, and we've seen that occasionally. But ultimately, a market like crude oil, which is the world's largest, is really hard to influence if you're a speculator. Simply, it's a $3 trillion plus dollar market. You need to have a very, very large amount of capital.
Although, Francisco, we have seen those prices move in the past. A few years ago, before we got through the financial crisis, there was a lot of concern about speculation in those markets.
Well, and you know, we never found much evidence of speculation driving prices higher in
well, it certainly wasn't supply-demand that was responsible for the entire run all the way up to $140.
Well, I mean, we disagree with that. We think the supply and demand played a key role. We had a substantial shortfall in diesel in the second quarter of 2008 that led to a substantial run-up in light sweet crude oil prices.
We've seen almost a 20% climb in crude oil prices just in the last couple of weeks. You think that is because of supply and demand, because maybe a quarter of Libyan supply came off the market?
Let me just give you the numbers. So we talk economics rather than just discussion. Look, I mean, we think that the price elasticity of demand is roughly 0.4 to 0.5 to every 10% move up in commodity prices. We've lost about 2% of oil supplies with Libya going offline.
Libya's not entirely offline. There's some people who say it's 400,000 barrels that are offline. That's not 2% of the world's supply.
Well, I mean, it potentially could be 2%.
It potentially could be, but it's not.
Okay, let's say 400,000 barrels a day. That's 0.5% of the world's supply. That's a 10% move up, right? And by the way, we don't know if it's 0.5%. I do think it's actually higher. The IEA
came out numbers when we don't know exactly if it's 0.5% or 2%.
The IEA came out yesterday with a note saying 500,000 barrels a day to 750. That's at least 1% of the world's supply. So, you know, on our price elasticity of demand number, which is, you know, a simple econometric calculation, we're looking at potentially a 20% move up in oil prices. How much have prices moved up? You just said it, 20%. Economics work, you know.
So you think you think prices are fair here, and you think prices were fair a week ago at $80 because of the fact that Libya was still pumping at full supply at that point?
Well, first of all, prices weren't at $80. That's for WTI, which is a crude oil that's
I'm
really
talking WTI now.
Well, WTI is an irrelevant crude to the world markets right now. WTI is only relevant. No, it's not. To Americans, it's irrelevant as well. It's only relevant if you're a refiner in the Midwest. If you're in New York City...
Well, that's pretty important if you're somebody who's buying gas in the Midwest. To America, it's fairly important, the price of the
No, but again, just around the Midwest. If you're in Texas, if you're in New York City, if you're in California, the WTI price is irrelevant to you. It's only relevant to a group of Americans, but actually it's only relevant to a group of refiners.
All right, where was Brent? Okay. Where was Brent 2 weeks ago? We've seen it trade as high as 118.
Was trading over $100 a barrel. It was already trading at 100.
Yeah, now it's at 118. So how much has Brent moved? 15% or so?
Brent's moved 15%. So that's consistent with our calculation, right? We've had a supply shock, prices move up. I mean, I don't think there's any question.
If Saudi Arabia is able to come up with this, and again, it may not be the light sweet crude that some of the European refiners want, but if Saudi Arabia is able to fill in a matter of weeks that supply, you think Brent prices should come back down to about $100?
I think Brent prices should come down if Saudi Arabia puts an extra million and a half barrels a day of oil in the market.
Okay. All right?
So I think that's fair to say. Now, the question is, if they do that, how much spare capacity are they going to have? And that's the concern that the market is going to start to build on. Because remember, monetary policy remains very easy, and no central bank wants to take the step forward and hike substantially to slow down their domestic demand growth rates, because everyone's trying to recover from the Great Recession we had a couple of years ago. So it's going to be a hard balancing act here for the next few months for the global commodity markets and for the markets more generally, to be honest.
Okay, Francisco, I'd love to continue this conversation. We'll have to have you back again soon to watch what happens.
Great.
Thank you.